Home sales climbed steadily in March, April, May and June, and then in July, all the gains were wiped out in a month. These are tough times for volume builders. The houses are getting smaller and there are fewer being sold. It's all part of the deleveraging cycle we're in, with people downsizing and paying down their debt. The Aussie dollar downsized again today to the mid-103s. Most analysts reckon it's still overvalued, but it's staying up because interest rates in Australia are higher than elsewhere. This chart compares our 10-year government bond yield with the average of other AAA stable countries: Canada, Switzerland, Sweden, Norway, Singapore and Denmark. Our rate is 2% higher than their average, which is pulling money into Australian dollars. Now, another way of looking at that, of course, is that we're being screwed. Why should we pay 3 times the interest rate of those other governments? The US share market was steady overnight while the big European markets went up, despite a fall in German business confidence. In Asia today, the Chinese market recovered a bit, but the stocks in Japan fell. The local market closed up thanks to gains across the industrials, such as Myer, QR National and CSL, while most of the resources sector went down. Virgin Australian shares closed steady, even though the company reported a $22.8 million profit today, compared with a $67 million loss last year. Meanwhile, Qantas reported a big loss last week, so the fortunes of our 2 major airlines are rather different, which is reflected in their share prices, as shown in this chart. Qantas is still valued at 2.5 times Virgin Australia, but at the rate Qantas is losing altitude and Virgin is gaining it, that gap is narrowing fast. And that's finance.